All right. It's time for us to get started. Good morning and welcome to the OneAscent Market Update for Q1 of 2024. My name is Cole Pearson. I have the privilege to serve as President of Investment Solutions here at OneAscent, and I'll be our host and MC for today. For those of us who are in the South where we are, it's a cold, snowy morning, so I hope everybody is safe and staying warm today. But as we get started, let me open us in a quick word of prayer, and then we'll kick off our time together. So join me. Heavenly Father, Lord, thank you for today. And God, thank you for even the snow on the ground. I do pray for safety, for travel, and just for protection for those who are affected by the weather, and for us in the South when we're not used to it, Lord. So I pray that you have your hedge of protection over us. Thank you for our time this morning, the chance to talk about investing in markets and finances in light of the fact that you own it all. And so, Lord, I pray over our time now. I thank you for those who are joining and who will be listening. Pray for our speakers, for Nathan and for Bob, and that you give them wisdom and the words to speak. And we pray over our time now in your son's name. Amen. Amen. Well, again, welcome to the OneAscent Market Update call for Q1 2024. My name is Cole Pearson, and we are joined today by Bob Dahl and Nathan Willis, our Director of Portfolio Strategy. It looks like Bob's joining us from the airport, so we'll introduce him more formally in just a moment. But if you have questions throughout our call today as we get started, please send those to info@oneascent.com. You can also use the chat feature here in Zoom, and go ahead and mark your calendars. We hold these calls the third Tuesday of every quarter, so you can go ahead and mark your calendar for April. We've been doing these now for about 5 years with consistency, so thank you for joining us this morning. I'm going to kick off our time just real quickly talking about values-based investing, which is critical to what we do at OneAscent. So Nathan, if you'll advance the slide. In quarters past, and hopefully you've heard us talk about these things, but the way that we approach values-based investing, we use these 3 E's to talk about how do we apply our values into the portfolios that we manage. And so those 3 E's, just as a reminder, number 1 is to eliminate. We eliminate certain companies whose products or practices cause harm. We simply have lots of data, and I'm going to show that in just a moment, of how we identify those issues, and we remove them from our universe. Once we've done that, we're left with the last 2 steps, which is to evaluate, and that's our traditional investment process, making sure that we're finding great companies who meet our investment objectives. So the idea is to find a great investment, but ultimately for us as values-based investors, we want to be deploying capital and directing capital to those companies that are worthy of elevating, those companies that are making the world a better place. And so at the end of the day, we hope that our portfolios really have 2 things that are true about them. The portfolios are made up of companies that are both great investments, but also great businesses that bless the people and places that they touch. So that's how we do it, how we approach it. And what I wanted to do today was just give really an offer and share a little bit more about how we do that practically. So if you'll advance the slide, Nathan, just a quick window into some of our software. Over the last year, 2023, we've been working very hard to develop this proprietary platform. It's called Elevate. So it's our own system and tool that allows us to do all of this work and create reports that you all can take advantage of. So a few quick facts. There's 8 different eliminate issues. Nathan, if you'll advance, we've got some pop-ups there at the bottom. 8 different issues that we kind of screen and scrape for. There's 47 different sub-issues that roll up to one of those 8 items. Nathan, if you'll just keep clicking, go ahead and click 2 or 3 more times. There you go. 47 issues, 70,000 different companies or issuers that we can screen for, and in total about 3.9 million different data points that our team is now assessing on a daily basis. So that's our tool. The offer I wanted to make to you all today is, if you'll advance one more time, is just a free assessment. If you'd like to know where your portfolio stands, if this is something that interests you, if, hey, I've got values and I've got investments, but are those aligned? You can visit our website, oneascent.com, and you can select Analyze My Investments, that button there on the right, and it'll take you through the process to getting started with that free assessment. We'd love to do that for you and serve you in that way. So just as we get started, I wanted to make that offer. And now I will turn it over to Nathan Willis, our Director of Portfolio Strategy, to give a few high-level remarks on the market and our outlook. And then we'll turn it over to Bob Dahl in just a few moments for his top 10 predictions. So Nathan, take it away.
Thanks, Cole. It's great to be with everyone today. So normally what we do is that we have Bob share his wisdom with us, and then I share how that applies to our portfolios. So I'm going to try to give you the answers before we give you the reasons for those answers, and hopefully make it cohesive. So what I'm going to do today before we hear from Bob is I'm going to share an overview of the broad markets in 2023, particularly with a focus on how they impacted a balanced portfolio. That's mainly our focus for the OneAscent portfolios. We're going to talk through our navigator process briefly and give a little bit of outlook for a balanced portfolio. And then we'll suggest some things that you might want to do in your portfolio. But first, let's talk through returns. I think one of the biggest things that I would say is that stocks defied predictions of a pending recession. Everyone knew that we were going to have a recession and stocks wouldn't do great. And yet, let's look at what happened. In the fourth quarter, all U.S. stock returns were double digits, and non-U.S. stock returns were really good as well. And if you look at the year-to-date returns, every stock market that we track was up double digits. It's a fantastic outcome. So you can look counting up from the bottom. Emerging markets was 10%, developed markets and small cap US stocks were up 16, a little bit more for mid caps. All of that was great, but all of that was blown away by the returns of the S&P 500. So it was really a really large cap and a growth driven market. Bonds avoided 3 years of losses in a row, which has never happened. And it's also interesting to note that they really did that in the fourth quarter. So if you see right in the middle of the screen there, the Bloomberg Aggregate Bond Index was up 6.8% in the fourth quarter. It was negative through the end of the third quarter, and that brought it to a 5.5% total return. And then finally, stock gains broadened out in December. Looking at this bottom category of growth versus value, value actually outperformed growth for December. But look over to the year-to-date returns, growth just trounced value. And that really started in the second quarter in March, really, when AI, artificial intelligence, and the earnings associated with that started to kind of take hold of people's mentality. Another way to illustrate this is to look at the long-term disparity between growth and value. So this next chart shows growth minus value, and what this is looking at is the Russell 3000 Growth Index. So the largest 3,000 companies that are growth oriented minus the largest 3,000 that are value oriented. And you can see they were up 30% more than value stocks in 2023. And that's the second most they've ever outperformed, right? So we had a tremendous outperformance of growth during 2020, which was the pandemic kind of characterized by stay at home, and that evened out in 2021. And then tech earnings in particular were hit by inflation concerns that hit PE multiples in 2022, and that really bounced back in 2023. So I just think it's really worth knowing that this helps me kind of talk about one of my themes for today, which is uncertainty. Everybody was sure we'd have a recession. Nobody, if we had a recession, would have expected growth stocks to outperform value by 30%. So it's just worth knowing and remembering that as we evaluate. Next, what I want to do is share a couple brief comments about portfolios. These are our elite portfolios, and what we usually focus on is the moderate portfolio, which is benchmarked to 60% stocks and 60% bonds. And so we didn't keep up with that portfolio. If you didn't look at the benchmark, and your portfolio was at 10.8%, you'd be thrilled. You're only upset because those tech stocks really took the S&P on a much greater return. And we, in general, are a little bit lower weighted towards tech stocks and a little bit lower weighted towards large cap stocks in general. And that hurt our 1 year return, and that's then affected our 3 year returns. But our 5 year and 6 or 7 year returns are still really strong. And so it's very important to note that we build portfolios for the long term, and we're not going to change what we do based upon one sector outperformance in 1 year. So then I also want to kind of give another little insight to how we think about uncertainty. So Visual Capitalist does a lot of great information, and this was a survey. There's going to be a recession in 2024, and so yellow, we kind of ignore them because that's CEOs and they kind of like to talk down earnings, so they have a lower bar to beat. But we really do pay attention to the Fed, right? Because they're determining policy, and so we know the Fed is going to be right. So let's go back to what Ben Bernanke said a year before the global financial crisis. We don't expect spillovers from subprime market to the rest of the economy. So we need to take the Fed with a grain of salt because they're not necessarily smarter than the rest of us, but they do determine policy. But two things we really like to pay attention to are the yield curve, because that's what the market is telling us. And we pay attention to consumers because they're really driving the economy. But I think the point here that I want to make is there's a lot of uncertainty about what's going to happen in 2024. Another way I like to illustrate that is by looking at bonds. And the reason I look at bonds is I think there needs to be a shift in the way we think. Bond markets are really going to be driving things as they have for the last couple of years. And so when we're looking about thinking about stocks, we need to think about what bonds are going to do. And so this chart here is from our friends at Apollo. They run private credit strategies. And this is the volatility or the broad change or the range rather of forecasts for 10-year treasuries. And see, through 2019 all the way through 2022, it was pretty narrow range. That range of what people expect interest rates how do we react with that? What we do is we go to our process. And so our process has us look at the economy, technicals, market sentiment, and valuations. So before I hand things over to Bob, I'll just go through a couple slides. Increased a lot. And that's important because that's obviously going to slow down the economic after a recession. And right now, there has been more bankruptcies in the last year than there have been any year since the global financial crisis. And so it's important to watch that and pay attention to how that's going to affect the economy. Then I'm going to share a couple of things related to valuations. So what I've shown here is a 20-year chart for the S&P 500 large cap stocks in yellow and brown here. And you can see that they're well above average for the last 20 years. But then I also show small caps and international stocks in the two blue lines. And they're both pretty close to average. And so what I wanted to do here is pay attention to the long term. This is not a chart about 2024. This is a chart about the next 10 years. What we do when we think for the long term, we know that starting valuations matter a lot. And so remember, this time last year, the US stock market was very overvalued and it went up 26%. So this has nothing to do with what's going to happen in 2024, but it has to do with what might happen and what's likely to happen over the next 10 years. We feel a diversified portfolio of stocks is very, very appropriate. In fact, more appropriate than it's been for the last couple of years. Finally, I'm going to bore everyone again by talking about bonds because they're very important. And right now, they're very important if you want income. And so this blue line is the Bloomberg aggregate, the broad bond market yield. And it's up to 4.6% when I put this together at the end of the month. S&P 500 dividends, however, are still very, very low. And what this means is if you look at the bottom, when it's green, that means bonds are yielding more than stock dividends. And for the first time, really since the global financial crisis, we're yielding 3% more. So we're getting a lot more income from bonds relative to stock dividends. And that's important. I think bonds are a very good piece of the portfolio, particularly if you want income right now. So I haven't gone through all the slides, but we are very neutral right now. That's what this yellow means. We have no green positives on the board right now. In fact, the economy is still a negative, not a huge negative, but it's still a negative. So how do we think about uncertainty and what might happen? I'll tell you what we're doing before I hand it over to Bob. First, we are very diversified in our stock portfolios, which hurt us last year, but is the right move for the long term. And it's how you can be confident that we have your best interest at heart. Second, we're keeping our bonds and we're happy about our bonds. And we're doing a lot in our bond portfolios to maximize our returns and minimize risks. Finally, we're adding alternative assets where they're appropriate. They're not for everybody, but they can give you a smoother ride if that's what you desire. So how does this play out? We again usually talk about our now we are just a little bit overweight in stocks. But if you look here, our stock allocation is very broad. We have a lot in small and mid cap and a lot in international. And then in bonds, we don't have a ton in government bonds. We're actually overweighted in high quality corporate bonds. And we always have a weight to high yield bonds, and we have about 4.8% of this portfolio. So we're not overweight. That's probably the riskiest part of our bond portfolio right now. So we're watching that closely. But we're very, very diversified, and we're prepared for what might come. So that is the highlights of what I wanted to share with you today. But let me turn it over to Bob. And so to introduce Bob Dahl to you, who you all know, Bob is a good friend of ours. And I also wanted to just point out that we just got an email this morning that Bob was promoted to president and CEO of Crossmark. So let me be the first to publicly congratulate you, Bob. And thanks as always for being with us. I have your deck up now. I think I got it right from the technology standpoint. So let her rip and give us your wisdom, Bob. You're still on mute, I think.
Let's try it that way. Can you hear me clearly?
Perfect.
Awesome.
Thank you.
Thanks for the kind words. Hi, everybody. Happy New Year. Let me just bridge a couple of things that have been said by both Nathan and Cole before I dive into these slides. And we're going to go through them quickly. Nathan, I probably have way too many slides, but we'll make a few points. Starting with a value comment, I'm going to agree, Nathan. And I just read on the plane coming in how much better value stocks tend to do than growth stocks in election years. So it's another tailwind for the value story. Bonds, agree with you. Key part of the investment outlook. I'll say it this way. I think stocks will have a hard time doing well if bonds aren't contributing to the portfolio. And finally, back to the beginning, and Cole's comment, Harry Pearson taught me everything I know about biblically responsible investing in my early years before becoming part of Crossmark, where I do it full time. So glad to partner with my friends at OneAscent on these portfolios and now to share the market outlook. So on to the slides. Flip away. You already commented on this, Nathan, but I just want to make one more point, or the same point a different way. While returns were pretty much across the board good, look at the difference in the S&P 500 total return and equally weighted index. 26 versus 13. That's a near record. That's just another way to say if you did not own the Magnificent Seven, it was a struggle. And many of us own pieces of the Magnificent Seven. In fact, I own some of all of them in my portfolios. But other than Microsoft, they're all underweighted, and I should have triple weighted all three of them with 2020 hindsight. Next slide. Here's a picture of the S&P 500 for 4 years. I remind you where we've come from. The pandemic all the way on the left. Seems like ages ago. It was painful to live through. But look at the reward that came after that. A bull market that it's hard to explain in stocks and bonds because money was thrown at the problem. It always goes to financial markets. 22 first half was a disaster. First time ever stocks were down 20% while earnings estimates went up. Choppy second half. And then, of course, last year, mostly up. Better year than almost all of us thought. Coming into last year, the consensus was we're going to have a recession. By parallel, the consensus today is we're going to have a soft landing. Don't worry about it. I am a bit skeptical, as Nathan is also. Next slide. So this is from Strategas, one of our investment partners, a letter they got from a client. Hey, team, I'm a simple man in many respects. I do not know how you get 11% earnings growth and 5% revenue growth in the same year as the Fed cut rates 6 times. You guys are very bright. What am I missing here? You can't have it both ways, in my judgment. And therefore, the theme of our predictions is Goldilocks remains a fairy tale. The fairy tale would be Fed's going to cut rates 6 times, and we're not going to have an inflation problem, and the economy is going to grow, and earnings are going to grow double digits. To me, it's probably going to be one or the other. The economy slows, and we don't make double-digit earnings growth. That's our bet. Or we do make double-digit earnings growth, the economy is good, but then inflation doesn't tame like the Fed wants it to do. That's the essence of the "you can't have your cake and eat it too" argument. I think it will be a theme for many months to come. Next slide. So here are some questions that if any of you have the answer, please call me, because I think these are among the key things we have to figure out very quickly. Are the consequences of the Fed raising rates from 0 to 5.25 in the shortest time in history over? I don't think so. Is the inflation dragon slayed? I think inflation will continue to come down, but be stubborn and not get to anywhere close to the Fed's 2% target. Will higher for longer interest rates be replaced by lower and faster? Will unemployment rise noticeably? The job market has been amazingly robust, and therein lies the issue we have to watch very carefully. Will something break? Somebody said it did last April. We forget this few banks went under very quickly. The Fed came to the rescue. Can we achieve the consensus double-digit earnings growth? I'm dubious. Will valuations, multiples stay high? We'll see. We'll look at that in the 10 prediction. Who wins the election? I'm not sure we want anybody to win the election of the front runners, as most would say. How about those wars? Will they stay contained? Lord willing, they'll end, but that would be nice news. And will China get through their problems? We could spend the rest of the hour on China. Next slide. So another way to look at this balance is on the bull case and the bear case. I think Nathan could be the bull and I could be the bear, and we both have credible arguments. Or we could switch positions and both have credible arguments. It's a very confusing world. I won't take the time to go through these. You'll be able to have these slides if you're interested and go through them and see which side you're on. Next slide. So this summarizes the introduction. Let's just move on to the predictions, Nathan, in the interest of time. Number one, the U.S. economy experiences a mild recession as the unemployment rate rises above 4.5%. We think the consequences of what the Fed did are not yet fully felt. There are long lags, and I'll show you a picture of that in a minute. And you see these other headwinds. I've deliberately put twice as many headwinds as tailwinds because I lean to a weak economy. Not bearish, not thinking we're going to have some very nasty recession, just a slowdown that defies gravity and confuses a lot of people with this double-digit earnings growth. There are some positives. Hopefully there'll be a few more that show up. But we've got this list of negatives, some of which have been around for a while. Some are just showing up. I leave the details to your reading. Next slide. Yellow's okay. This is the excess savings held by consumers. This came from COVID. The checks mailed by the government and the amount of money people didn't spend because they stayed in their pajamas for months. That together combined to raise about $2 trillion of excess savings. And I think many of us that thought the economy would be weaker last year missed how powerful this is, but you can see it's waning. Depending who you talk to, we're down to roughly $250 million. Here's an important slide. We are impatient. Fed raises rates, the yield curve inverts. We've got to have a recession. And then when it doesn't happen, we say, well, I guess that law has been repealed. We're not going to have it this time. Look at the detail on this slide. The average time from when the Fed raises rates to the onset of recession is 10 quarters. We are in our 9th quarter as we speak. So it's not as if this won't show up. It just is not even the average amount of time. So take a chill pill, I say to myself when I look in the mirror and say, are we ever going to have a recession or not? Next slide. There's our 4.5% in unemployment rate that we're targeting. I create this slide to show we're not looking for much of a rise of the unemployment rate. I mean, look what happened. Refresh your memories in COVID. It was a disaster. Next slide. So prediction 2, the 2 to 3% inflation ceiling of the last decade becomes the 2 to 3% inflation floor of this decade. We went through an unusual period. We didn't talk about inflation last decade because it was nearly zero. And there were, as economists would tell you, some structural issues that caused that to happen. Most of those same economists would say what was 2% last decade is probably closer to 3 now. So I think getting inflation down to 2 more than for a minute or two is going to be very unlikely. So we need, and there's a big difference between 2 and 3 when it comes to valuation levels, both for stocks and bonds. Next slide. And is the mission accomplished when it comes to inflation? It's nice to say headline inflation dropped from 7 to 3, but note that the main reason is energy fell 5.5% over that time frame. Core inflation, which is more stable, falling from 6 to 4 is good news, but 6 to 4 is easy peasy compared to 4 to 2. Getting from 4 to 2 is very, very difficult. So this, you hear me dubious on the inflation getting to 2. Next slide. Sorry, I didn't read prediction 3, but we can do it on this slide. The Fed cuts rates fewer than 6 times suggested by the Fed Fund futures curve. Most of you know there are futures out there on all kinds of things, football games, elections, and the markets. And the market is saying the Fed will lower rates 6 times during the course of this calendar year. And our view is we don't think so, not so fast. Inflation's not going to behave as well as it needs to for this to come true. So we're arguing 3 or 4, not 6, which has consequences for obviously interest rates out the curve, as well as the valuation level on stocks. Next slide. Credit spreads widen as interest rates decline. With the October 31st pivot by the Fed, basically saying, without saying it, we're done raising rates and we're going to pivot and go the other direction in due course, that caused credit spreads for high yielding corporates to narrow significantly. We think there'll be some rise in that as the economy slows and potentially some sort of recession. Next slide, Nathan. So our base case is that Treasuries, which ended the year at 388, that's the 10-year, move back up in the 4s, which they are even as we speak, modestly into the 4s. Target the year end slightly lower at 375 with some widening of credit spreads. Next slide. This is a long-term slide. I a year ago gave a different version of it, but it's the same message. That is, inflation and interest rates in the U.S. peaked around 1980 when Paul Volcker came along and said, I'm going to get inflation out of the system. He put us through 2 recessions, one of them very nasty to get there, and set off a 40-year period of declining interest rates and declining inflation, which ended in August of 2020 when the 10-year Treasury was at 52 basis points. So for those 40 years, if you bought a bond, it probably went up. Maybe not every day, or maybe not the first month or 2 you owned it, but eventually, because rates went down. Same thing with stocks. I know I bought a lot of bad stocks in those 40 years, and I often got bailed out because the valuation went up as interest rates declined, even if the fundamentals were mixed. It's harder now. Doesn't mean we can't make money. Nathan already hinted at this. The longer term returns are probably not going to be the same as looking in the rearview mirror over the last 40 years. Next slide. Earnings growth falls short of the double-digit percentage consensus expectation. I've already mentioned that. Here's some numbers. Our best guess baseline is that earnings are up mid-single digits versus the consensus double digits. There's a big difference. Long-term earnings growth, I remind all of us, in the U.S. is between 6 and 7%, not 11. For 11, you need strong top-line revenue growth as well as improving profit margins. I think both of those are going to be a challenge. So again, we're not bears on earnings. It's just that we just don't see them reaching these lofty levels. Next slide. So suppose we do have a recession. What happens to earnings in recessions? Well, here's the history. Earnings are down 20 to 25%. No one is calling for that. We're not either, even though we think we will get a mild recession. So this is hopefully the outer limits, but I need to bring it to all of our attention so we keep our feet on the ground. Next slide. Number 6, stocks record a new all-time high early in the year, but then experience a fade. We think it's going to be a harder year than last year. Both because, to repeat, valuations are challenged, which I'll come on to with a couple of numbers in a second, but also because earnings don't quite live up to expectations. Stocks struggle the most when real GDP is 0 to 2%. When it's below zero, they know the Fed's coming to the rescue and stocks go up. When earnings and the economy are growing well, the stock market does okay. It's this 0 to 2 that's a problem, and I'm afraid that's probably where we're going to be this year. Next slide. Here is the beginning of a couple of valuation slides. This looks at 6 valuation measures: price earnings ratio, EV to EBITDA, et cetera, the current level, and most importantly, the historical percentile off to the right. And you can see versus history, with the exception of the free cash flow yield, stocks haven't been more expensive this in a long, long time. Next slide. So what can happen to the stock market this year? Well, our base case is a 20 PE times $235 in earnings, which gets us to 4,700, which is about where we are today. If we have a recession, earnings will be weaker, and we could revisit where we were, believe it or not, 2 Octobers ago, 3,600. And our bull case for the economy is not a bull case for the stock market, because while earnings will be better, PE's probably not. And so we come up with a 43.50 target. I wish I had better news. I'd like to make it 53.50, but intellectual honesty, we think it's going to be a tough year to make money. Next slide. We've already covered this. All this shows in the blue lines is what percentage of the stocks beat the average. And you can see it usually hovers around 50%, as you might think. Half do better, half do worse. Not last year. Last year, it was less than 25%. Comes back to the average stock lags so noticeably. And the proof of that, of course, is the right-hand side to show how well the Magnificent Seven did. Median return of 83%, average return of 112%. Tough to keep up with that, as we all know. Next slide. So here's a look at a long-term comment I've already alluded to, as did Nathan. When you see this is interest rates. When interest rates go up, as they did from, call it, World War II to 1980, stocks compound at 5.5%. When interest rates go down, stocks do better than double that, almost 12%. And now interest rates have stopped going down / gone up. I'm not saying they're going to be as bad as 5%, but I think it's going to be closer to 5.7, 11.8 over the next 5 to 10 years. We have to reset our expectations. Next slide. In fact, here is a slide that shows starting PE on the left and what the subsequent 1, 3, 5, and 10-year returns. When I was making these predictions, every time I looked at my slide, I saw 20 point something, 20.3, 20.5, 20.1. PE's around 20. What typically happens in the next 1, 3, 5, and 10 years? Much lower returns. Valuation is not a short-term timing tool, but it does give you some sense of what your potential and your risk is. Next slide. Sectors. If any of you listened to call last year, I hope you don't remember how badly we did on the sector prediction. Over the years, we've gotten about 72% right. Our sector calls have been in the 80s, but we blew it last year. So with a grain of salt, or 2 or 3, our belief is energy, financial staples will outperform a basket of utilities, healthcare, and real estate. Energy and financial, just a word there, they're very cheap stocks. Most call them cyclicals. Yes, they have cyclical elements to them, but because they're so cheap and their cash flow is so strong, I think there's a chance they behave somewhat defensively if, in fact, we have a sloppy market. Next slide. Part of the reason we like those sectors is what you see here. First column of numbers is their earnings weight in the S&P. The second column is their capitalization weight. So if I buy an energy stock or the energy sector, I'm buying 4% of the stock market. But the energy sector is delivering for me 7.5% of the earnings, almost double. Financials, you see the same kind of spread. It's among the reasons we like these two unpopular or sectors that didn't do so well this year. It's nice to see financials out of the gate this year doing better. Next slide. Number 8. This is a bit self-serving for those of us in the faith-based money management business, but I've been thinking about this kind of prediction for some time, and it's time to make it. It is that faith-based share of industry assets under management rise for the 8th year in a row. We are in a small industry, small component of a huge industry. And you can see the share that the faith-based market has had is going up 7 years in a row. Our view is this will be the 8th. Next slide. Why? Well, this is not exclusively, as you all know, a Christian endeavor. There are lots of Christians who play this game, but you know, what person do you know doesn't want to invest in companies that are doing good and avoid companies that are doing bad? It's an attempt on the part of individuals, institutions to line up their investments with their values. It is not ESG. I wish I had time to expound on that. Maybe there'll be a question on it if we have time for questions. How much return do I give up? Lots of empirical studies say nothing. You know, it was just a great thing to be able to say, you mean I can get similar returns and get good companies and avoid the bad companies? Yep. There's the avoid, embrace, engage. I think avoiding bad companies and embracing good companies. OneAscent pays attention to that. We at Crossmark do. There are a few others. I would argue if you're in this space, you want to not just avoid what we're against, but focus on what we like. We have a goal, all of us, that we hear well done, good, and faithful servant. Next slide. Next slide, we'll skip this one. Just the players. Okay, number 9, geopolitical cross currents multiply, but have little impact on markets. Let's take the oil and the Middle East. The Middle East is a mess. We all know that. But other than for a few days here and there, oil prices have behaved themselves because it hasn't spread to being a problem for oil. This list here, extreme polarization, 2 unpopular leaders running for president. You can read the list. Maybe number 7, a lot of people are not aware of this. 80% of the stock market capitalization in the world, 60% of global GDP, 40% of population having a national election this year. That's a record. And so we probably will see some turmoil around all of that. Next slide, please, Nathan. Why little impact? I already gave you the example. I hope this is right. Maybe this is Pollyannish thinking. We're not saying that cross currents are going away. We would just say, keep your eye on this space. Markets tend not to pay attention to things unless they're pretty definable. They tend to look the other direction and focus on earnings, which is the right thing over the long term. Our emotions based on these macro issues can bounce all over the place, but stick with the good companies that have the good positive aspects and good secular valuation propositions. Yes, sir. Next slide. Number 10, we always have an election prediction. We went out on a limb a little bit this year, say the White House, Senate, House, all switch parties in November. That would mean we'd end up with a Republican president, a Republican Senate, and a Democratic House. Americans have kicked the bums, quote unquote, out of office 9 of the last 10 elections. That has not happened since Reconstruction. So there is this thinking like the guy who's in office now isn't so good. Let me try somebody else. And that's a very popular thing. Here are the key issues. I point the one out at the bottom. I hope this is not the case, but are we going to have the Supreme Court playing a significant role in the election year because we're so polarized and some states are so close? Next slide, please, Nathan. Here's some factoids around elections. I'll just mention one of them. When an incumbent president runs for re-election, as Joe Biden is doing, and there is no recession in the 2 years leading up to that re-election, that incumbent has always been re-elected. Conversely, in the 2 years leading up to the incumbent's try at re-election, if there has been a recession, that incumbent has never been re-elected. So there's one full proof. We have a recession this year. We probably don't see Joe Biden next January and vice versa. Next slide. I can't mention a set of predictions and touch on Washington, D.C. without mentioning the debt and the deficits. For years, it didn't matter because interest rates were low, even as debt went up. But now with debt up and interest rates up, we've got a problem. We're going to have to tackle this at some point, or the bond vigilantes will come back and hit us over the head with higher interest rates. God help us. We do need some help here. Next slide. So let me pull this together with a couple of final slides. Conclusions. I've touched on most of this, but let me for completeness. A delayed recession shows up. Inflation falls, but not to target. Fed lowers rates, but less than expected. We're not going to get the earnings growth consensus expects. Stocks are pretty expensive on most measures, as we showed earlier. Therefore, we want to focus on stocks with good earnings predictability, good earnings persistence, and strong cash flow. Do not buy a stock because you think the valuation is going up. That may be a fool's game this year. Do some dollar cost averaging into international. I like the fact that OneAscent is diversifying. Like Nathan said, and I can attest to this personally as well, it didn't do well last year, but this is the kind of environment you want to be diversified. Expect some dollar weakness. Keep your eye on the geopolitical threats, as well as the nonsense around the polarization we have related to the election. Next slide. So what do? I'm going to answer this as a portfolio manager, including for OneAscent's large cap value, large cap core, large cap growth portfolios. I expect choppy markets. So whether it's an individual stock or an industry or the market as a whole, trying to buy the dips and trim the rallies and be not let the emotions carry the day. Focus, to repeat, on earnings growth and cash flow, not valuation expansion. Own some fixed income. If you look at our slides from 2 years ago when the 10-year treasury was 1.5, we said if you could have zero fixed income in your portfolio, do so. Different story now at 4%. Diversification, I'm going to repeat it, especially for geography. Value and growth, I want some of both in my portfolio. But on the value side, not just because it's cheap, it better be high quality, have something to deliver. And growth, I'm just going to be stingy into how much I paid for it. Consider an absolute return strategy to complement your market or your beta exposures. And we would argue for both stocks and bonds. Be prepared to step up if we get significant weakness and do some buying. So I think we have one slide left, Nathan, and that is thanks for the privilege of being your portfolio manager on these three portfolios. You know, the Magnificent Seven really hurt the growth portfolios, not so much in value because they're not in any of those benchmarks, and core was somewhere in the middle. So thanks for the time. I hope there was some value added here. Nathan, do we have time for a question or two?
I think we do. We've got time maybe for one. Bob, first, thank you for being with us. I mentioned we've been doing these calls for 5 years. You were on the very first one of them. So we thank you for your partnership, and even amidst travel. And Bob has taken this call from the airport. So thank you for sharing your time and wisdom with us, Bob. We really do.
My privilege. That. My privilege, Cole.
I may ask, Nate, if you'll go back maybe one slide real quick, just to not distract everybody. To cut through all the noise, Bob, there's not that this is noise. There's a lot of information that you've shared. But maybe what is the one thing that gives you the most cause for concern, and the one thing that gives you the most reason for optimism in 2024? What would those two things be for you?
The optimism is that there are a lot of doubters out there, and there's a lot of cash on the sidelines to represent that. The thing I worry most about is this: we're gonna have a soft landing. Don't worry about it. I don't think it's that simple.
Yeah. Awesome. Well, good. Well, we've tried to keep shortening these calls to maximize our time, so we'll cut it there. Lots of good information. This replay will be available. Bob, again, congratulations on the promotion.
Thank you, Cole.
To CEO and president of Crossmark. Nate, if you'll advance one more time as we wrap up, just for our listeners. Thank you for being with us this morning. If you'd like to learn more, get in contact with us. You can do that on our website, investments.oneascent.com, or email. Lots of information, as well as a replay of this call will be made available. So thank you for spending your morning with us. We appreciate it. Thank you for your partnership, and pray you have a blessed day. That'll wrap up our call. Bye-bye.